FORA.tv. The world is thinking.
Professor Stiglitz, you have had an inside view as a policymaker in your previous role as chief economist at the World Bank, and you've never hesitated to identify the hazards of errant policy making during economic upheavals. You said earlier this week that stupidity was one of the causes of the current crisis. Stupidity on whose part?
That's not a refined analysis, but on a part of everybody. Let me just give you a couple examples. One of the basic precepts in economics teached in the first course is there's no such thing as a free lunch. Many of the banks thought that they could, through high leverage, get a high return without risk. You take a 20, 30 to 1 leverage, a small percentage change in the price of your asset, and you're wiped out. And they were betting that even though it was clear we were having a housing bubble, that the prices wouldn't go down. But now we're talking about a decline in housing prices of 30% or possibly more. And that goes back to the depth of the numbers that you were referring to in the IMF numbers. We don't really know how bad, because if the prices continue to decline and nothing's been done about the foreclosure, those gaps are going to get even larger. The regulators also were stupid. And Greenspan almost admitted as much. They believed that people were rational, and they could self-regulation, which is an oxymoron, would work. And it was so clear as they were undertaking this excessive risk that they were putting at risk the whole economy. But what's so interesting about this is, given the incentive structures, there's every reason for the bank officers to undertake those. So we created incentive structures that would lead to excessive lending, exactly what we got. It was rational in that sense. It was irrational for the regulators not to realize that rational responses to bad incentive structures was going to lead us to a problem. But now, just to give you a couple more examples, right now, we finally learned that the pro-cyclical policies that the IMF imposed on Thailand in '97, Indonesia, all around the world, were bad. So we're having counter-cyclical policies, lowering interest rates, expansionary fiscal policy. But what is the IMF still doing in a number of countries, including some that are very strategically important, like Pakistan? Pro-cyclical policies, high interest rates, business can't get any capital, on top of the current crisis. So that's an example where they seem to be very slow to learn the lesson. Let me just give one more example. One of the other precepts that we give in, second lecture in economics, you shouldn't, bygones are bygones. You shouldn't chase good money after bad money. Well, just think for a minute. If we had taken the $700 billion we talked about in TARP and created a new bank, looking forward, not looking the past, but looking forward, and leveraged that just 12 to 1, that would have generated $8.4 trillion of new credit. No problem with credit supply if we have been forward-looking rather than backward-looking. Now, one of the ideas that I think is a bad idea is the bad bank. I know there's some disagreement on that. But the bad bank idea is just the new version of the old idea that was discarded, I thought, which was the cash for trash, where we would take on all the assets that no one else would touch, and somehow the government is a better garbage disposer than the private sector. This coming from a lot of people who believe that the government shouldn't do anything, that why government should have a special facility in garbage disposal. The new version of this is bulk buying garbage in bulk. So we buy huge amounts of garbage, and then we become a bulk disposer of garbage. Now, the problem with the new garbage, the experiences of the past are important, but the new garbage is different from any of the old garbage that we've ever dealt with. And that's because it includes these explosive, toxic derivatives. And think about what that means. We've given $150 billion to AIG, one company, and most of that money has disappeared. Now, that's one company. Now, we take on all those derivatives, and I don't know if you remember the numbers that were floating around, 20 trillion, 30 trillion, 40 trillion, and you put them on the U.S. taxpayer. We never had a responsibility. We had a responsibility for the S&Ls. We had deposit insurance. We never gave deposit insurance. We never said we would provide backstop for these credit default swaps. But that's what we would be doing, in effect, if we assumed all those bad assets onto the public balance sheet. So we have to figure out what to do with those and not put them on the public balance sheet. Our national debt has already increased from $5.7 trillion when Bush became the president to over $10 trillion. With this, even if we do the right thing, we're talking about several, $5-7 trillion more. If we don't do it right, we're talking about a national debt that is very hard to manage. And then you talk about the issue that several people have mentioned, tensions. Already in the United States have mentioned a cutting back on Social Security when we've been giving all the banks the money. We would have put Social Security on a sound financial basis for 100 years or more with the money that we've been spending on the banks. So now you're asking what the trade-off here, giving all the old age people in America security for the next 100 years versus bailing out a few banks. And that's the bad bank idea. And if you go ahead with that, I think it raises real issues about social values.